So welcome everyone, LePoidevin Group, kind of mid-year call. It's time for an update. Lots to talk about, some similarities, but some updates. And we are going to get right into it. Now today I'm going to slightly change it. For those of you in Toronto, weather-wise, summer started this week. So we're not going to spend a lot of time. I've got some questions. There was a lot of questions about the economy going into recession. Okay, so we're going to go with I've got a lot of questions. I'm going to answer a lot of these questions as we go through the presentation. So it'll be a little bit of a shorter call today, and we'll go from there. So title is U.S. inflation hits 9.1%, which is a bit of a shocking number. As we know, highest in since 1981. Rates fall 1%. Rates go up 1%. Bank of Canada. I'm going to outline actually why this is a good thing for us as investors, other than a little bit of a scary ups and downs of the market. And we're going to talk about this consensus that is for a recession. So as we go through here. This is a fact. The first half of the year, the worst since we've had since 1970. And again, you know, we were talking in May on the last call, and the markets had already deteriorated significantly. I mentioned that we were holding up and well, and of course, we're not nearly as bad as the markets, but the market has decided, as we go into this recession that everybody sees coming, that they're going to sell everything, whether it's energy stocks or preferreds or anything. So it's kind of hit all asset classes, and I'm going to go through a lot of this stuff. So this is from that previous slide was from Forbes. This is from the Financial Times. U.S. set for recession next year, economists predict. Now let's talk about this for a second. This is a LePoidevin letter from 2008, so it's just the actual letter. It's not very glossy. Back in old technology days, there were no conference calls. I just did letters, and this is February of 2008, and we came out and we said to our clients, we are in recession. And we had also been warning for a little while, because if we look in August of 2007, we talked about the problems in the United States with subprime lending. And again, this was going to create a recession. Now, I ought to tell you that this was a lonely call. Like, there were very, very few people that sounded the alarm bell. Dave LePoidevin, David Rosenberg, who was in Merrill Lynch. I remember Peter Schiff, and you can Google this or YouTube it, was talking about a problem with subprime, and people were laughing at him hysterically for his prediction of a U.S. Housing meltdown. Now let's remember that the U.S. had raised rates 17 times going into this recession. But again, very, very few economists predicted it. So, you know, here we are, and let's talk about this for a second. So we talk about the worst year since 1970. Now, I did a little teaser on my call. I said this indicator has only happened twice since 1950. And one of them was 1970. And it's very rare that there is unanimous consensus amongst investors. 1970 was one of those times, so it's only happened twice, that the data was coming out and unanimously investors, it was a survey of small business owners, 92% or 93% expect a recession. So it's consensus. So this has only happened in 1970 and 1987. 1970, as we say, the worst first half of the year 50 years ago. But lo and behold, the market got it wrong. That consensus was wrong. The market ended up returns of 6% in 1970. So everybody knew we were going to a recession in 1970, and it never materialized. Interesting. The other one that we, very similar to today in 1987, the market bottomed in June in 1987 and bottomed in October of 1987. And if we can remember 1987, US Fed was raising rates aggressively, 1% per meeting, as the Bank of Canada just did a couple of weeks ago. And, you know, but the stock market still had a net return of 5% for the year. And by the way, it was a foregone conclusion. The market crashed. We were going to have a recession. The Fed had gone too far. And lo and behold, it didn't materialize again. So the only two times that the market absolutely had an overwhelming conviction of recession were both ironically wrong. You know, this is an interesting chart. Let's talk about recessions, because by the way, it's all but certain in this Canada, in Canada, it's highly probable. In fact, it's even possible that we're already in a recession because we had a negative first quarter. But let's talk about recessions for a moment. So everybody now is an expert on the recessions, and in recent memory, on the bottom of this list is the 2008 recession. The market bottomed in March of 2009. And this red line over here is the recession of 2008. And you can see that the market fell about 47% during that recession. So people are very worried about the possibility of recession. Well, hold it a second, because I'll talk about this in a moment, but let's talk about the next one up was 1990, which was a drawdown about 22%. And then we go up to 1981 and we see the market dropped about 12%. And we see 73 and 2001, we were kind of in the 10 to 12% range of recession. So with the market having year to date from a possible recession start to already down 20, 22 or 3 from the peak, you know, have we gone too far? Look, as we went through 2007, the United States did something that it hadn't ever done before, and that was that they invented a new asset class called subprime lending. And these were collateralized mortgages that you put them all together. There had never been mass foreclosures in the history of the United States, and therefore they would be AAA rated, and it was thriving. And, you know, the old saying, if you could fog a mirror, you could get lending. It was a real problem as well that we identified in 2007, that in 2008, a lot of these mortgages, a little bit different than Canada, but a lot of these mortgages would be teaser rates. So your mortgage payment might be $1,000 for 2 years, and then it would reset higher. So they were going, oh, I can afford $1,000. Well, then it would reset to $3,000 in 2 years. And, you know, there were tears and people said they didn't understand it. But every single company that was involved in subprime lending went bankrupt. Every single one, without exception. Bankruptcies of subprime lenders went, foreclosures went to over 11% of subprime. And recovery was about 24 cents on the dollar. Mass foreclosures, and the result is we know what happened. This time around, if you have a mortgage with Wells Fargo or Bank America, that the lending practices are nowhere near. So the United States is very, very well prepared for an economic slowdown. Now let's talk about interest rates as well, because on the subprime, there was just these teaser rates and a lot of subprime lending was short term. A conventional mortgage, which is 90% of all lending in the United States, is a 30-year fixed mortgage. So rates are going up, and you have a mortgage that you refinanced last year at 3. Your rate does not change. So rates going up only affects someone who's moving and needs to refinance. So is there a US housing slowdown coming? Yes. Is it a repeat of 2007? No. Honey, rates are now 6. We're not moving. We're renovating. We're going to stay where we are, but it doesn't affect us. So it's very interesting to see that the market is very, very quick to say 2009, but recessions maybe are not that bad. So headline, just last week, US inflation hits 9.1%. So does this mean that interest rates are surging? Well, we're going to talk about that. Now, if you were watching our calls from 2001, we had predicted that inflation would go a lot higher. And we said, no, you do not want to be in the deflation camp. You don't want to be in cash. You want to be in assets because inflation is going a lot higher. Now, it was very easy for me to make that prediction. Now, this is a chart of the money supply in the United States. It was a similar thing really in the Western world. The money supply exploded by very, very quickly by 25%, and then ultimately went up 40%. So money's being diluted, things are going to go up, and as we know, we were handing out free money, and we said the consequence is going to be, I remember in my call, inflation was 0, and I said that interest rate, inflation might hit 4, and it sounded like a crazy prediction, but here we are at 9. But I want to, if we look at the right-hand side of this money supply, so this line over here is 6% growth. This is the pandemic deflationary environment that led to inflation from money supply. But let's isolate the last 1 year. Interesting thing is happening. The money supply from December to now is kind of rolling over. So the US Fed is stop printing. In fact, they're taking away money. So this, it's not hard for me to come to you and say that inflation is a phenomenon of money printing. I've talked about it on my call. The reason a can of Coke when I was a young kid was 10 cents and now it's a loonie is not that Coke is more valuable in society. It is that they printed money and money is worth about 10% of what it was when I was a kid. So money supply is the root cause of inflation. You could say shortages of this or that, but at the end of the day, it was going to show up somewhere. But we now see money supply rolling over. And it's interesting that one of the root causes, the first thing that went up with the money printing is this is the commodity, CRB is the Commodity Research Bureau Index, which shows us commodities. So it's biggest commodity in the index is energy, oil, natural gas, but it also includes orange juice, wheat, pork bellies, which is bacon, and you know, the like. So we can see that the deflationary forces, so here you are bumping along and commodities are kind of flat. The deflationary forces of locking everyone down in the pandemic. Money supply is printing. The pandemic is kind of, we're learning to live with it. People are going back to work and they're spending. And the money supply explodes and commodities really, look at the index, 115 to triple. I mean, we see it at the grocery store. Bread, the biggest component is wheat, you know, beef prices, bacon. I mean, it just went nuts. But it's kind of rolling over. And interesting. Talk about interest rates. We mentioned this on our last graph. Inflation is at 9, and yet if we look at a 10-year bond in the United States is yielding 3%. A 10-year US inflation bond where you get inflation plus is yielding 0.6. So the difference is 2.4. So the market, the bond investors are saying that they expect inflation to be 2.4 for the next 10 years. And you can see the inflation expectations actually went to 3, but they've rolled back to where they were kind of, back here in 2021 when we were in the pandemic. You can see that pre-pandemic, you could see inflation expectations were just above 2, similar to where they are now. It's actually interesting that we were kind of going through, as commodities fell, a very low inflation environment. I think we're at the end of free money. Interesting as well. So as inflation keeps going higher, this is US 10-year bonds, and this is kind of the benchmark. Canada has very, very similar interest rates, but interest rates peaked in June, and they've been coming down. So since April, we're actually seeing, of course, interest rates way up from a year ago, but we can see that interest rates have actually been anchored right around that 3% level, plus or minus, since April, and yet inflation is going higher. So what's going on here? So if inflation has peaked, and I'm not saying inflation isn't a problem, then we have to say, okay, so the market is pricing in a recession. Recessions, if we look at 81, 93, 73, 91, 73, what do we do? And one of the questions we have is, what do we do for low risk? What do we do for seniors? How do we make money in this environment? I mentioned this on my last call, and I get a lot of questions like, I'm down, I'm dropping. Well, are you down? Well, first of all, we bought most of our Enbridges over here, up here. But Enbridge B, if we look back last July, the shares were trading at $18. They spiked at 20 and a half. These preferreds last month were announced because every 5 years, they have to pay a rate of 2.4 plus the 5-year Canada. So last month, the dividend was forced to be changed from 85 cents a year to $1.30. So at $1.30, paying just over $18, we're making over 7%. Now, are we down from 2050? Look, at 20, we're still making 6.5. We are not interested in selling. Just people, in 5 years, you're going to collect $6.50 of dividends. This is an unbelievable thing to just hold. One of my clients said, hey, GICs are at 4.5. Why don't we just go no risk and put the whole thing in GICs at 4.5%? Well, why would I sell something that's got a dividend of 7 to buy 4? Not only is it 7, if you own this in a taxable account, for most people in a high income tax bracket, you're paying about 50% on interest bearing. So if you put it in GICs, our partner, CRA, is going to take half. We get to keep half. Well, our partner, Canada Revenue Agency, on a dividend lets us keep 70%, only takes about 30% in a taxable account. So the 7 is actually, I got to get 9.5 on a GIC to be the same on an after-tax basis. So am I going to sell my Enbridge B for a GIC at 4.5? I am not. So it's interesting that the shares have been going up and down, but I'm not interested in selling And these are unbelievable investments. Let's talk about BCE again at 1850 or 1840. Did spike to $21, but here we were, you know, buying it over here, went there, took a leg up. But last April, the BCEs pay whatever the prime lending rate is. The prime lending rate was 2.7%. Now that's based on $25. So at 2.7, the math was 63 cents of dividends. So we were at $18 making almost 4%. Pretty good when GICs were 2. The dividend, because the prime lending rate has been going higher and higher and higher. In fact, the Bank of Canada just raised by 1%. So prime in one day went from 3.7 to 4.7. The dividend has been going higher, higher. Now, the dividend on this monthly payment, it was done mid-month. So the dividend is $1.07 from 63 cents. Unbelievable. The dividend next month, because it was done mid-month and the whole month will be sitting there at a prime of 4.7, is $1.17.5. $1.175, 17 cents. So at that yield, we're making over 6.5% from Bell Canada. Bell Canada was incorporated in 1858 and has survived many, many recessions. And are we worried about the credit quality? We are not. And the term, if you look at the term structure, the market is pricing in a 100% chance of the Bank of Canada raising rates again in September. Now, again, 100% chance. We've all seen it when the weatherman says it's going to be sunny and it rains. Well, you said 100. But the weatherman is usually right when they're at 100% chance of showers or rain. I'm not golfing, and if it's 100% chance of sun, I'm not particularly worried. It does happen, but the Bank of Canada going up another 1%, sorry, half of 1% is what the market's pricing in, means that my dividend will have to be increased again, and I'm making over 7. So am I worried that I could have sold? I'm down from where it was theoretically trading. It's still a bargain at 20 bucks. 1840 is more of a bargain. I was speaking with the derivative trader, which is things like preferred shares at Scotia, who's really the biggest trader for institutions. And we were talking about what's happening here. You know, why did they come off from $20 to $18? And what we're seeing is massive redemptions from small investors through exchange traded funds. In fact, one of the branches or a large investment broker put up for redemption 2.5 million shares of the Bank of Montreal laddered preferred, which is the largest in Canada. 2.5 million shares of $10 stock is $25 million. So the exchange traded fund that day had to go and sell $25 million. Now this is happening on a daily basis. What we talked about is institutions, people like Canada Pension Plan, smart money is just quietly buying these because the returns are as outsized as you can get on even a riskier common stock. Again, preferreds rank preferred to the common, way safer. Enbridge called in all the preferreds on a US issue that was paying, the reset is going to cost them 6.05%. So they called that in. They said, we're canceling that. We're going to give everyone $25. These Enbridge Bs at 25, again, they decided not to call them, was paying 5.4. So what they're doing is they're quietly buying back all of the preferreds that are the highest. So the highest yielding first, the one that cost them the most. Let's talk about Enbridge for a second. Enbridge is in the pipeline business. The environmentalists have said you cannot build any more pipelines. So imagine you're the toll master of the Lionsgate Bridge. You're not allowed to build another bridge. You can't even renovate it. All you're going to do is collect fees. So what's Enbridge going to do with all this extra capital? They're going to just be buying back their preferred shares. So one by one, they're going to buy them back. So they're buying them back at 6. So the fair market value of Enbridge B, the market's already told us, is $21.60. If it takes 5 years to get there to $21.60 from 18 and change, coupled with our dividend of 7%, it's a compounded return of 10.5. Unbelievable. It's unbelievable this stuff's around. This is why I'm excited that this stuff is out there. And the only reason it's out there is because people are pulling in their stuff to buy GICs. And that's great, because when rates were zero, we're competing with all the dumb money that flooded into stocks that's flooding out. Now let's talk about so we talked about the US recession. United States is not going to go through another 2007. Mortgages are fixed. So it doesn't create the same need. If we have a recession, it might be in 1970 and 1987, where the foregone conclusion is we got a recession. And it may muddle along. It could be a mild recession. Again, recession is, are you growing after inflation? Well, inflation is so high that it's highly probable, if not possible, that the economy grows at 5, inflation grows at 6. Well, technically you're in a recession. But let's remember, you're still growing. Profits are going up. Yes, profits are only reason profits are going up is because you raise the price of cereal if you're General Mills, but you're still making more than last year and you're raising your dividend. So let's talk about a very important difference. Canada had a very small subprime market in 2008. Our real estate market was barely hit. In fact, it went down about maybe 10%. And then the market rocketed higher and has been going higher ever since. The United States got hit. Housing prices fell officially 36%. I have clients that bought stuff below 50 cents on the dollar. Some of them, one of my clients, something that had traded at 1.3 paid 300,000. Like crazy stories of massively marked down real estate. Canada, nothing. This is a chart, and thank you, Ben Rabideau, great guy, North Cove. He really does his homework on Canada real estate and has all the statistics. And I've pulled out a few highlights. So the monthly mortgage payments in Canada on a typical home. So that just takes median house prices, median income. And it's very interesting. House prices during the pandemic were up 40, 50%. They were going ballistic on the upside. Now, in the Consumer Price Index, I've said this on my calls, go back on my calls. We've had lots of examples. What matters to most people is what is my monthly mortgage payment. So if we look here, 2018, 2019, as they dropped interest rates in the pandemic, even though house prices were going up, the monthly mortgage payment was actually dropping despite massively rising house prices. But today we've got a 50% increase in house prices since pre-pandemic, and we have a doubling of interest rates. So keep in mind, pre-pandemic mortgage rates were kind of up to about 4%. They go down to 5-year fixed mortgage goes down to 1.5. Yes, your house price is up, but your mortgage payment was lower, so you could afford a lot more house. So today, with mortgage rates, and this story just keeps getting worse. Yesterday, RBC just raised their 5-year fixed mortgage to over 5.5. So this is even old news, this story. There's a 55% increase, someone whose mortgage comes due. This is the highest we've seen since 1981. And If you're as old as I am, if you're Marc Rinfret, you have to read about it in the history books. But if you are as old as I am, it was a bloodbath, and there were many, many foreclosures. So let's talk about another thing. Sales. This is in Canada, sales to new listings. We got mortgage rates. We've got free money. People can sense the end of lockdowns and COVID. Bidding wars. There's no, so people are not selling and people are buying like crazy. Sales to new listings hit a record, actually right in COVID as rates went down, and they just stayed nuts. This index is plummeting. So this tells us that there are more listings coming onto the market that are not selling. Now, again, it's not in panic zone, but it's getting there. We just experienced the biggest decline in real estate prices in one quarter in the history of Canada. Now, I hear a lot of, well, in my neighborhood, the prices aren't dropping. Look, if you're in West Vancouver, if you're in Lawrence Park in Toronto, you really haven't noticed that prices are dropping. If you're in Brampton, Ontario, if you're in Surrey, look, there was a phenomenon that happened, which was, hey, we need you to work from home. Well, people were sold their condos that were $750,000, and they bought in Surrey for $750,000, a nice townhouse or a nice house. These places are down 20 to 25%. But let's remember, the phenomenon of higher rates is going to hit the whole market. It's slow. The market takes a while. There are people that had qualified for mortgages before rates went up and are panicking to sort of buy in. Foreclosures take a long time. So if you're someone whose mortgage came due, and even if you're variable, your payments are fixed until you come in. So unfortunately for the variable rates, your payment stays the same, but you're going to pay out almost no principal. So you're going to have your $1.6 million mortgage is still going to be $1.6 million, and now you're going to be forced to have this 55% increase. It might be more because the amortization gets smaller. Anyway, I don't want to get too technical, but it's going to take a while for everything to roll over. If there's a foreclosure, the company does not have to report it's delinquent for 90 days, and then they don't tell you until their next earnings call. So we're not going to see any headlines on this stuff really till year end, but the house prices are going to get weaker and weaker because the Bank of Canada isn't about to cut rates. They're still raising rates. So look, Canada is going to have a much tougher go than the United States. The United States is in good shape. Canada was in good shape in 2008. No subprimes. Now we have a vibrant subprime industry, which has, from a lot of measures, now exceeded the US subprime industry in 2007. So what do we need to do going into Canada's credit problem? First of all, if you have an investment property, you've got big gains in it, just consider selling it. Take your money, hold it back, put it in a T-bill, put it in a, cash, and just wait for a year or two. This is really important, people. Outside of the big six banks, the Canadian Deposit Insurance Corp is 100,000. Do not go over this limit. If you have to, if you've got 500,000, split it up between 5 banks. Do not exceed 100,000. Now, I don't think for a moment Royal Bank is going to default on its GICs, but there are a lot of smaller institutions that you're going to be vulnerable on. My recommendation is to avoid credit unions. There are risky lenders, they're small, there's huge exposure to residential real estate. In British Columbia, there's a notion that the whole thing is guaranteed by the province. That hasn't been tested. The province cannot afford I know at National Bank when we were there, the lawyers scrutinized it and said that's a very weak guarantee, and there was clauses that they could get out of that. So please, just this is the black swan that that we could be facing in this country. So let's just not test it. Let's remember as well that if you're sitting with money in a credit union in U.S. dollars, or even money at Equitable Bank, none of that is deposit insured. Just remember that, even U.S. dollars. This is time. There's a lot of people with, you can see the commercials on BNN all the time. I have been earning returns of 7%, and it's all secured by real estate. These are high risk mortgages. These are subprime lenders. If they're giving you 7%, they take a 1% fee. They've been lending money out at 8 and 9%. Those rates are going to be north of 10 under the rising rate environment. If you borrowed $2 million, how in the world are you going to be able to pay 10% on a mortgage? So please, mortgage investment corps, mix funds, Antrim, Rothmanson, all kinds of firm capitals. They're out there, and a lot of them are $500, $1 billion. Avoid them. Avoid investing in subprime lenders. EQB Inc. used to be called Equitable Home Capital. Canadian Western Laurentian are the biggest subprime lenders in this country. Avoid them. There's a lot more. There's smaller ones, First National. Please do not invest in those. They probably are going to go to zero. This might be a 2024 story because of the lag, but in 2008, you didn't want to own Citibank. You didn't want to own Wells Fargo or Bank America, because there will be even losses at the bank level. And I'm not saying they're going bankrupt, but those losses hurt earnings. So you're going to have a massive decline in earnings. And, you know, a little like what happened in the United States, if it happens in here, the same result will be dividends get cut, and they get cut by the regulators. The regulator goes in, Office of Financial Supervision goes in, and they say, oh, Rolla, you're paying $8 billion a year in dividends on your common stock. You can't lose money and pay a dividend because you're putting the depositors at risk. So they just say you can't pay a dividend. So, you know, what are the shares worth at that point? Well, European banks trade at 70% of book value. Citibank trades below book. Why in the world would Canadian banks trade at 2.5 times book? So they've got, you know, they could fall 60 or 70% under a scenario, which if, you know, if this black swan hits in Canada, that's, you know, that's a possibility. So look, recession, mild in the United States, a mild recession is fully baked in. What do we do in this environment? We collect dividends, we make smart investments. One of the questions that we had is, if we know the market, if we know the market's going down, why don't we just sell? Well, we don't know it's going down. It's highly possible that the market bottomed on June the 16th. We talked about on our last call, year 2 of presidential cycles. This is the toughest year since 1950. Year 2 of presidential cycles is the toughest. We said on our conference call it's going to be a tough year. But the good news is, in year 2 of presidential cycles, again in 1970 it bottomed in June. Year 2 of presidential cycles, the market typically bottoms in September, going into the midterm elections. So year 2 of presidential cycles, the market actually is very, very strong. Market's typically down to September, and then it does very well from September to year end. So it's highly possible that the market gets normal. People start realizing that you can get 7% on an Enbridge. BCE Bell Canada is on its way to yielding 7. I mean, guys, these are dividends that I haven't seen since the early 1990s. So I'm excited, not because our shares are down $1, and I could have sold them up there. I'm not selling anyway if they go up $1, because the dividends are just too good. So I'm excited about the opportunities. I would say the question becomes, the client should be asking is, where are the opportunities? These are the times where successful investors make money. There's always opportunities, but there's things, it isn't just go in and blanket buy. There are problem areas that that in Canada is going to get hit a little bit more. But let's remember, it's going to be a recession in some areas. Home builder, you know, a Canadian home builder might feel like a recession, but an oil and gas company, you know, may be booming. You know, 1991, 81, we had strong energy markets. Alberta was a completely different environment than Ontario was. So there's pockets of boom and there's pockets of pain coming. You know, if you have debt, be careful of that debt. If you are an investor, we welcome the higher rates because it gives us opportunities that we have not seen in 20 or 30 years. So that's it. I've already spoken as much as I should because we had a lot to cover. As usual, if I haven't got to any of things that you wanted me to cover, send me an email, drop us a line. Marc and I, Darcy and Fletcher are here to answer questions. But we are going to be very active in this market, and I'm excited, first of all, for year end. So let's not judge our year yet. And secondly, I'm excited about the fact that we can now just collect amazing dividends and get a pretty good return. So that's it, everyone. Thanks for stopping by, and we'll see you on the next call.